Welcome, everyone. As I mentioned, my name is Alidad Vakili. I'm an attorney with Foley and Lardner. I am in the San Francisco office, also in the Silicon Valley office. I'm in the corporate practice group, and most of what I do is geared towards representing companies at all stages of their life cycle, but in particular focus with a lot of startups and emerging growth businesses. So it's everything from inception to liquidity, or as we like to say, from garage to global. It's helping them get started, forming their entity, making sure they've got all the proper documentation and agreements in place, helping them raise capital, handling the whole financing round from soup to nuts, getting them to close on their round, and then to move on as the company grows and matures with all sorts of other issues that come up. So I'll go through a little background and the overview of the presentation, and we will get started. So just really quickly, another housekeeping matter. I'm talking about very general concepts today. What I discuss may or may not be applicable to your particular circumstances. So I certainly don't want anyone to consider anything I'm saying today to be legal advice. This is general educational material. I'm happy if you have a specific question and want to talk to me directly to have a call separately after the meeting, reach out to me via email, and I'd be happy to talk to you about your particular circumstances. But just be aware that this is basically general information. Hopefully it'll be helpful and give you some guidance, but not to be intended as legal advice. Okay. The overall agenda, there's a lot to cover. I'll try to go through as much of it as I can. There'll be some areas where I'll spend a little bit more time and a little bit less on others just to make sure I can cover everything, keeping in mind the focus of how to do a venture capital financing transaction. So there'll be some things that maybe early on in the company's life cycle you need to be thinking about to sort of help you on the road to prepare for your first VC financing. I may not delve into those with as much detail, but I do have several other webinars that I do, and some of those go into more detail. For example, talking about safes and convertible notes, sort of your early seed financing options that many companies use. Those go into more detail on that, as well as another webinar I've given on how to avoid big startup mistakes. So that's focusing really just on where we see things go wrong, how to get in front of them early on so you don't make the same mistakes. So we'll touch on briefly structural considerations, important documentations early on. What are the financing options? As I mentioned, talk a little bit about convertible securities, your notes, your safes, talk a little bit about valuation and dilution, and then we'll get into sort of the overview of venture capital financings, how to get investment ready, what to do to prepare for closing, and then some of the common pitfalls if we have time. And I will open it up for Q&A. Try to reserve about half an hour or so, maybe a little bit less for Q&A, and I try to reserve those questions till the end. I've kind of done it a couple different ways. Sometimes I'll take questions during the middle of the discussion. I think it's probably most helpful to wait until the end. So if you do have a question, as I'm talking about a topic, please put it in the chat. Once we finish up, I'll go through and start going through the chats and questions, make sure that we touch on as much as we can before the end of the program. Okay, so let's talk a little bit about my background. As I mentioned, I'm a corporate attorney with Foley, focus a lot on emerging growth and venture capital. That's sort of the majority of my practice. Working out of our San Francisco office, been practicing over 25 years. Love working with entrepreneurs, founders, investors, and really along the whole life cycle of the company. So from very, very early inception all the way through exit. A little bit about Foley. Next slide. We're an Am Law 50 law firm, full service law firm. We handle sort of everything from A to Z. We do corporate, IP, environmental, real estate, tax. There probably aren't many, if any, areas that we don't do. The nice thing about that is we bring to our clients a wealth of experience in a lot of different areas. So, we oftentimes, being a corporate attorney, will help set up the company or get the company going with the financing, but inevitably issues come up, and whether they be employment or IP or litigation or a number of other areas, we handle the sort of the full gamut of all of that. So it's nice to have the reputation, experience, and knowledge of all the folks at Foley to be able to provide our clients really a true full service experience. We handle a lot of different areas, as I mentioned. The four main industries I think we focus on: healthcare, life sciences, energy, innovative technology, and manufacturing. But within that, obviously, a lot of different sub areas. Again, a lot of things we do, and I won't go into it too much, but there probably aren't too many business areas or types that we haven't dealt with and don't represent on a regular basis. So that's a little bit about me and the firm. So let's jump into the meat of the discussion today. So I think one of the first considerations, and maybe you've already passed this, but if you haven't yet set up your entity, but you've got a great idea, you have an idea for a startup and you want to get going, the first questions you should be thinking about, or first issues really, is what entity should I set up and where should I set it up? And you've probably heard a lot of different things. Hopefully they're all sort of consistent. If you intend to go and raise money from third parties, and especially intend to go the typical route of many startups, which is eventually to get to the point where you can do a VC financing and bring on the bigger institutional investors that have the bigger checks, that have the experience, the smart money, as we say, because they have contacts, connections, experience to help the companies grow and scale, then you're going to want to set it up from the very beginning in a way that is most attractive to the venture capitalists. And that's typically a Delaware C corporation. The C corporation for a number of reasons, but basically it's preferred by the investors because most of the VC investors don't want any sort of a pass-through entity for a number of reasons, but they want a C corporation, which is basically very old established form of entity in the United States. It's got a very understood structure. The jurisdiction where a lot of investors want you to set up is in Delaware. And it doesn't matter where you are. You could be in California, Nebraska, Florida, but setting up your entity in Delaware is the preferred jurisdiction for a number of reasons. One, the code is very well written. It's reviewed and updated on a fairly regular basis. It's very well thought through as far as how to protect the company, how to give the company the resources to be able to manage effectively as they grow and scale. Investors like it. They understand the code. They're comfortable with it, and oftentimes will require that you have your entity set up in Delaware. Just some interesting trivia, if you will. Over 50%, but it's probably a lot higher than that, of all publicly traded companies, based in the U.S. are formed out of or set in Delaware as a jurisdiction. So obviously, as companies grow and scale, even when you get to the point where you're very large and you're going to go public, being in Delaware is going to be beneficial as well. Okay, so enough said on that. So let's talk about documentation for founders and early personnel. So all of this is with sort of the aim or goal of getting to the point where you are ready so that when you have interest from an investor, you've got everything, your house is in order, you've dotted all your I's, crossed your T's, ducks are all lined up, if you will. So it's a much smoother, more efficient, more cost-effective process to go through and do a venture capital financing. But keeping in mind that it takes some time to do all this, the prep work, if you will. And if you miss some of the steps or don't pay attention to some of the steps, then it can just create delays and more costs, and sometimes can create some issues with investors that are looking at your company. And we'll dive through a number of those today. I always say this: proper documentation is key. I can't tell you how many times I've seen a scenario, sometimes in the middle of a financing, where the investor on their diligence review raises questions about this document isn't proper, or it's missing information, why wasn't this entered into, where's the document for this? And you need to be able to make sure you can respond and provide the information. Otherwise, you've got to go down and clean up sometimes what can be a little bit of a messy thing to clean up. So getting the right documentation early on is key. Make sure you've got confidentiality agreements with the people that are working with you. And, make sure you've got what I call these CIIAAs or PIIAAs, and it really is an acronym that stands for Confidential Information Invention Assignment Agreement, or Proprietary Information Invention Assignment Agreement. Mouthfuls, but those are key terms that investors are looking for. And essentially, it's an agreement that you would enter into, including the founders, employees, advisors, consultants, anyone that's working with the company, and anyone that has access to information that could be sensitive or confidential, anyone that's helping, with the company growing, scaling. It could be development of IP, which is obviously really critical, or helping improve anything related to the company. Important to get those agreements in place. And essentially those agreements provide that, I'm working for the company in whatever capacity. Whatever I create for the company that relates to its business is going to be owned by the business. And I'll give you one quick story of why this is relevant. I had a client a number of years ago that had developed some technology. It was a software-based company. They had hired a coder to come in and basically code what was going to be the program they were going to use. They didn't have an agreement with that coder. So the coder did the work. It took a few months. They were paid. They went their merry way. The company a little bit later on was starting to grow and scale, and the question came up, well, where's the agreement showing that everything that coder did and developed belongs to the company? And they couldn't provide that because they never got the agreement signed. So it immediately caused a big red flag, because technically they didn't own the software that the coder had developed. The coder had written the code, and just by virtue of having created it, they had rights to that code. And unless those rights are assigned over to the company, if they walk away and leave, they take those rights with them. So the company had to go back to that coder and negotiate the purchase of the software and those rights. And it was a lot more expensive than if they had just gotten that agreement in place in the beginning. So can't overemphasize the importance of those. That's sort of one of the first things that investors are always looking for, is making sure that whatever you're telling the investor, that's this great story about this technology, this product, the service you've got, that's going to make a bunch of money and will give the investors a great return on their investment, that the company owns what you're saying is such a great technology. Another topic that's really important is vesting of securities. So, and this really applies to everyone. Anyone that's going to be getting any sort of equity in the company, including founders, there should be some discussion and thought up front about, what do we do as far as vesting? And investing essentially refers to, and I'll break out the discussion talking about options and stock because they're treated a little bit differently. But the general concept is, you come work for the company, we're going to give you some equity. The equity is going to be subject to vesting, so there's going to be restrictions on it until those vesting conditions, that time period has elapsed. And essentially the time period is, generally speaking, 4 years with 1 year clip. And that means you got to put 4 years of work into the company to be fully vested in that equity. And you don't vest in anything until you completed 1 complete year of service. And then you typically vest 25%. And then the remainder vests monthly over the remaining of the 4 year period, so the remaining 3 years. So at the end of the 4th year, you've fully vested in all the equity. And how that translates into protecting the company, one, it incentivizes people to stick around, because they know if they leave early, they're going to lose the equity that's not vested, or it's going to be subject to repurchase. So how it's done is a little differently with options versus restricted stock. I'll talk about options first. So you give someone an option, which is essentially a right to buy stock in the future at an agreed upon price now. That agreed upon price is usually referred to as a strike price or the exercise price. So as an example, you bring in a developer, company is a startup, doesn't have the budget to pay them competitive salaries. So you offset, you give them whatever rates you can pay. And you say, look, in exchange, I'll also give you some stock options. So you give them some stock options, the stock options will vest, and they will be allowed to exercise and purchase the stock over that 4 year period that I was mentioning. So after the first year, let's assume they get 1,000 shares. Usually the number is a lot larger, but for sake of this example, they get 1,000 shares on the day they get the option grant. After the first year of service, they will vest in 250 of those options. So after the first year, they could exercise and purchase 250 shares of the 1,000 shares that they were given an option to purchase. And then thereafter, it would vest monthly over the remaining time period until at the end of that 4th year period, they're vested in all 1,000 shares. And then at any time they wanted, they could exercise and purchase those 1,000 shares. If they leave before they vested, the unvested options, they go away. They expire, and they don't have the opportunity to exercise and purchase those. So essentially, that's protective of the company, because now you don't have someone who is no longer with the company, but has the ability to buy a bunch of stock from the company. On the flip side, when we're talking about restricted stock grants, in some cases, the company may decide, I want to bring someone in, don't want to give them options, I want to give them stock, but I still want the same concept of vesting to apply, so that if they leave at a certain point in time, without having fulfilled that 4 year period, I want the ability to take some of that stock back. So with options, if you remember, if they haven't vested, they haven't exercised, they don't own any stock on day one. If the unvested options, once they are terminated or they leave, the unvested options go away. With stock, if you give someone stock on day one, they actually own the stock. So they have a piece of the company on day one. But what you do is it's got a right of repurchase on it. So the company has the right to repurchase those shares that have not vested if the person leaves within that 4 year time period. If they leave before the stock is vested, the repurchase right will kick in and the company will be able to buy back all of those unvested shares. It's usually at the lesser of the original purchase price or fair market value. And in early stage companies where there really is very little value, it's very, very low. So it's easy for the company to exercise its repurchase right, buy the shares back that have not vested for essentially the same price that the person bought for them. It's usually fairly low. And that way they can claw back, if you will, those shares that haven't vested. So person walks away after 3 months or 4 months or 5 months before their first year of service, they walk away with nothing. The company can buy back all of the shares that were issued. So it's a great tool to use. And it's really critical because I've seen scenarios where companies haven't put those agreements in place or haven't done them, they haven't documented them properly. And what's happened is you bring in, let's say, a co-founder, and they get 20% of the company or 30% of the company, don't have these agreements, don't have any vesting. They walk away after 5 months. They walk away with 30% of the company, but they're not working, they're not contributing, they're not helping the company continue on its journey. So essentially they're what we call debt equity on the cap table because they're there, but they're not contributing at all to the company's success. And yet they hold a huge amount of the company's ownership. I mean, 30% chunk is huge. So you can avoid those scenarios by having the right documentation in place. So if someone like that left with 30% and they haven't vested, then the company can buy back those investor shares. So super important. Investors want to make sure you've got those documents in place as well. And oftentimes, if you don't, they're going to require you to have an agreement with the folks that don't have them in place to put vesting conditions on their equity, even if you haven't done it before. So something to keep in mind. Transfer restrictions are important too. Having shareholder agreements. If you are setting up with multiple co-founders, sometimes it's helpful to have a shareholders agreement, which is essentially an agreement between the co-founders to manage particular contingencies that might come up. So what happens if you've got 3 or 4 co-founders, one of the co-founders decides, I'm not interested, I'm going to leave. Well, the vesting and restrictions we talked about will govern that type of scenario. But there could be other scenarios where, let's say, the person dies, is disabled, gets divorced. Some of those can be covered in that sort of restricted stock purchase agreement that I talked about, the vesting conditions. But if it's not covered in that, then you can oftentimes create what's called a shareholders agreement that can include those provisions, but could also include other provisions. For example, if you've got 2 co-founders that have a 50-50 stake in the company, before you get further down the line where you take on other investors and the ownership changes a bit, so you don't have a potential stalemate where a 50-50 owners could disagree, you can build in provisions to the shareholder agreement that manage decision-making authority, what happens if you can't agree, things of that nature. So important things to be thinking about with regard to any sort of initial setup and early documentation. Okay, let's talk about. I'm going to go quickly through convertible securities because we're really talking today about how to do a venture capital financing. So most venture capital transactions or financings are not done via a safe or note, and that's not an absolute rule, of course. Everything depends, as lawyers oftentimes say. And we've certainly done a bunch of deals where the VC firms have actually invested via safe or via convertible note. But generally speaking, when you get to your first VC financing round, it's usually referred to as a priced equity round because you're essentially selling stock in that round. If you issue a safe or convertible note to an investor, you're not selling them stock on day one. You're selling them a right to have their investment converted into stock at a later date when the company then goes and does a priced equity round and sells stock to investors. So I'm going to be talking primarily about the priced equity round, if you will, and I'll jump through this pretty quickly. So convertible securities, a good way oftentimes early stage or, for seed financing, company will use a safe or convertible note. I have another presentation I do that focuses a lot more on that. So I'm not going to go into the details, but they do provide some good pros. They have some cons as well, but there are some benefits to using a safe or convertible note, especially early on, where you want to keep costs down. You also want to get the financing done and in place very quickly. Those can be particularly helpful. Really quickly, the difference between a safe and a convertible note. A convertible note is actually a loan. The investors are loaning money to the company, so it's debt. and you'll have typically a maturity date, an interest rate. You'll have some of the same terms you'll see in a safe, but essentially it's a note, a loan that will convert into securities at a future date when the company does a price equity round and sells stock. The safe, on the other hand, is an instrument that YC came up with a number of years ago to make it very easy for startups to get financing. It's a relatively short document, and essentially the investors make the investment into the company, and they have a right via that safe document to convert their investment into shares when the company then does a price equity round in the future. And sometimes you'll define what that price equity round is, usually referred to as a qualified financing or equity financing. But whatever that threshold is, once the company meets that threshold, then their investment would convert into shares in that next round. Let's talk a little bit about capitalization, which is an important issue to think about when you're getting ready to do a venture capital financing. And obviously, it's important anytime you're taking money from investors. So even when you're talking about safes and talking about convertible notes, this is an important topic to be thinking about. But especially early on, if we talk about setting up a company, and if you've got multiple founders, allocating the equity amongst the co-founders, or even allocating equity to early employees or consultants coming in or advisors coming into the business is going to be really important. So you should be thinking about how to allocate, how to strike the right balance between ownership and what the person is participating or bringing to the company. And it's a little bit different, obviously, if we're talking about co-founders coming in. How do you allocate equity amongst co-founders versus how do you allocate equity amongst employees and consultants, advisors, et cetera. There's no absolute one way to do it, but generally speaking, obviously the co-founder scenario is very specific, as you really have to have a detailed discussion about what is everyone bringing to the table, what are they contributing, what's their vision for the company, how do they view their impact and their participation in the company. Those should all be factored in as to how to allocate equity amongst the co-founders. And it's not necessarily we're just going to split everything equally. It's one person maybe putting in more capital, one person is bringing contacts to the table, one person is bringing in knowledge and experience. You have to kind of weigh all that out and figure out how to allocate with what people are participating and contributing. With employees, advisors, consultants, it's a little bit different. Usually they get a very, very small percentage. There are some studies and some information out there that can kind of give you a sense of what market might be depending on the industry you're in and the kind of phase you're at of the startup. But there are some guidelines there. But with regard to capitalization, essentially it's ownership of the company. It also, imbued in that is control. So if you have obviously a significant ownership, you've got more control of the company. And you need to be thinking about every time as a founder, if you're going out and raising money by selling shares or issuing shares to employees, advisors, consultants, bringing in a co-founder. Anytime you're issuing shares or issuing or granting equity, then that's going to impact your ownership as a founder, and you're going to get diluted over time. So it's important to be thinking about that. We talked about proper documentation, so I won't go over that. Let's talk about some general terms that are important. Thinking about valuation and dilution. Pre-money valuation, as it means there, is the value of the money before the round of investment. Post-money valuation is essentially the value of the company after the round of investment. So you take the pre-money valuation, add whatever the investment dollars are that are going in, and that's your post-money valuation. Other couple of terms that are important to know: issued and outstanding basis. Basically, that means at any given moment, you can look at the cap table and know who owns stock in the company and what their percentage ownership is of the stock. That's important because that'll show you at a given point in time who actually owns stock in the company. Liquidity is another thing that's used oftentimes, and that refers to all the stock that's issued and outstanding, but you add to that securities that can be converted to common. It's typically it includes the equity compensation in like a plan, an equity incentive plan or an option plan. So if you issued a bunch of options, then a fully diluted basis, you'd be looking at, okay, I'm going to assume I got all the people I know own stock. I'm going to assume that all the people that I granted options to have exercised and purchased the stock that they have an option to purchase. Then I'm going to look at that total number of shares that everyone owns. and I'm going to total up the ownership to see what the ownership of the company is on a fully diluted basis. And that's important because as a founder, you want to be thinking about both numbers, but the fully diluted basis is going to be really important because if you're not paying attention to it and you're issuing a bunch of options and other convertible securities, assuming all of those get converted into shares, that's going to obviously impact your ownership. Your ownership is going to go down because now you've got shares that were issued. It's going to dilute your ownership, your piece of the company. So important to be thinking about that as you prepare for any kind of financing, really, but especially if you're doing a priced equity round. I'll go through a couple of quick examples. So one simple example, I'm not talking about the option pool or any other convertible securities, but just for purposes of illustration. Let's assume you have a company that has a pre-money valuation of 10 million. You've got 10 million shares that have been issued among 3 different founders. So essentially, they all have an equal share. Their ownership is 33 and 33% for each of them. You then go and get an investment of $3 million. And the investment's priced at $1 a share because you take your pre-money valuation divided by the number of shares that have been issued and are outstanding. And that gives you your dollar price point. The pre-money valuation is the 10 million. The post-money valuation is the 10 million plus the 3 million investment. So you have a post-money valuation of 13 million. And if you look at the ownership interest and what happens is, so founder A, they have 33.33% before the financing. They're going to end up with approximately 25% after the financing. And you can see the calculation there because they're going to get diluted as you then issue shares equivalent to 3 million shares at $1 a share to this new investor. Their ownership goes down to about 25%. The new investor is going to come up with about 23% based on their $3 million investment at $1 a share. And I'll illustrate this in a table format, so sometimes it's a little bit easier to see. So here we have the pre-money valuation, the capitalization, the investment of 3 million, post-money price per share, and then you can see how it all pre-money, what the ownership is, as well as the post-money once you have the dilutive effect of that $3 million investment. Let's now take another example here with a convertible security. So whether it's a convertible note or a safe, doesn't really matter for purposes of this example. But the point being is you have a convertible security where the investment is $450,000. There's a 25% discount. So what that means is with notes or with safes, you can sometimes get a discount, which means when the conversion occurs into shares, when there's a qualified financing and the conversion occurs, whatever price that is being sold to the new investors that are putting money into the company, and let's call it $1 a share, this 25% discount will kick in. So that safe investor or note investor that has a discount is going to be able to convert not at $1 a share, but they're going to convert at the discounted price, which is going to be 75 cents a share because they have a 25% discount in their document. So in this scenario, with a 25% discount, they're going to end up, instead of getting 450,000 shares, if it was converting based on a $1 per share value, they're going to end up with 600,000 shares. So obviously more shares because they've got the benefit of this discount. Let's talk about another scenario where there is a $450,000 investment, same type of convertible security. Now, instead of a discount, they're getting a valuation cap. And a valuation cap is in essence, it's like a discount, but it's calculated differently. Basically, what it says is, we're going to give you a valuation cap of 5 million in this example, so that if your pre-money valuation is more than the 5 million, for purposes of calculating your price per share that you're converting at, you're going to use the 5 million number. So obviously, if your valuation cap is less than the pre-money valuation, then that's going to be to the benefit of the investor because they're going to be able to get a discounted price on the stock that's being sold at the financing. So in this scenario, when you do the math with a 5 million valuation cap, same example, 10 million pre-money valuation, that's essentially half. So their $450,000 investment is going to net them 900,000 shares. So you can see the benefit of these type of provisions in your convertible securities, how that benefits the investor. But from a company perspective, it's important to know this because you're going to have more dilution Obviously, if you've given out safes or convertible notes with a discount or valuation cap, it's not a one-for-one exchange. It's not a dollar per share exchange. They're going to get a discount. They're going to more shares. The more shares that are issued, obviously, the more dilution is going to be impacting the founder. So something to be thinking about there. And again, here's a spreadsheet. I won't go through it. You'll be able to get the slides in the video when we send it out. But that illustrates the 25% discount. And then this illustrates the cap, the $5 million cap. Okay, so we're about at the half-hour mark. Let's jump into sort of overview of venture capital financings. We kind of covered a lot of sort of material that leads up to the venture capital financing. So once you've kind of done all that and gotten everything in shape, you've got good documentation, you've set up your company properly in Delaware, the C Corp, you've got all your documentation in order, everything's good and current. You kind of have a better understanding of valuations and how dilution can impact you. Now, obviously, part and parcel, or maybe parallel tracking it. Oftentimes, you're preparing your slide deck, you're preparing your business plan from the very get-go. But when you get to the point in time when you want to go out and start meeting and interacting with investors for your venture capital financing, you need to make sure you've got a good, credible business plan. It should be very well thought through. It needs to be polished. If you've done it before, obviously, you understand that. If you haven't, spend a lot of time to make sure you have a deck that you prepared that just hits the mark. And you want to sort of think of it differently. I mean, a lot of founders that I meet that haven't gone through that experience to raise money and haven't built companies, they're always thinking about it from sort of a self introspective position. Like, I want to tell the investors about my company and how great the technology is and how wonderful our team is and how much money we're going to make. All that's great. But you also want to be thinking about what is it the investors want to hear or need to see so that they're interested and that they can understand, okay, I get it. I already understand the technology because I invested in the space and I know what's good and what's bad and what's scalable, what's not, what's going to generate a lot of interest. That part I get. So what I want to see from you, company founder, is presenting, I want to see how am I going to get a return on my investment. So that needs to be very clearly spelled out in your slide deck. And again, I'm not saying you have to go into minutiae of detail, but you need to be able to demonstrate to them that besides all the other stuff that gets them excited, the technology, the market team, all that sort of stuff, how are they going to be able to make money on their investment? And when is that going to happen? Is there a trajectory? Are there projections you can provide? I mean, obviously, scalability, you could have the best concept for technology, but if it's not scalable, you can't really grow and scale the company to the kind of size that it needs to be able to generate a good M&A type transaction, or to get to the point where it could potentially go public, then a lot of VC investors, they're not going to be interested because you can't scale it. So one thing you should know about investors is they're putting their money at risk, and it is tremendous risk. If we think about the statistics, it's 1 out of every 10, 1 out of every 15 startups that VCs invest in hits it out of the ballpark enough to generate the kind of return they need to take care of all of the other investments they made that didn't make enough money or didn't make any money. So it is a big gamble for them. So they really need to make sure that if they're going to be investing, that it's got the potential to return the investment quite a few fold, quite a number of multiples to make it worthwhile. So scalability is important. Perfecting your pitch is important. I've heard a whole bunch of pitches, and find the right person in the company that can present, that tells a good story, that's comfortable talking in front of public. Probably everybody knows this, but the number one fear for most people is speaking in public. And if you're going to be addressing, a group of investors, or you're going to be at a pitch competition or something like that, you need someone who's really comfortable and can tell the story, in a really good way. Run a systematic process. Kind of go through, make sure you've got enough capital to get, to the next point in time when you can sit down in front of investors for venture capital financing. You don't want to be in a position where you're desperate, because the VCs they know their industry, they know their business really well. They are very good negotiators on what they can do and what they want. And so if you're in a position of desperation because you're running out of money and you need to get money, you may not be able to negotiate the best deal for yourself. Make sure you're connecting with the right investors. There's a lot of investors, a lot of VC funds out there. Some specialize in a particular industry. Some specialize in or focus on a particular stage of a company. Some are a little bit more agnostic. Understand who they are, what they do, maybe understand some of their prior investments. You just don't want to waste your time talking to an investor that typically is probably not going to be the right investor. If you've got a SaaS-based business that's in sort of the software area, online type of business, and you're talking to an investor that only does healthcare and you're not doing anything in healthcare, it's probably not going to be beneficial. With one caveat that it is a small community, so oftentimes a lot of the VC firms, they know each other, and even if they're not in healthcare, you might talk to one firm, or you might talk to a healthcare investor in a VC firm, and their buddy happens to be at another firm that does exactly the kind of investments that you need. So I'm not saying it's always not worthwhile, but you want to be selective and make sure you're talking to the right investors. Understand the right term sheet. What are the term sheet provisions? What is the term sheet? We'll talk a little bit about that. That's your starting point. So whether you've met them through a network, at a function, a trade show, a pitch competition, whatever it is, once you sit down and they show that they're interested, the next step is going to be to negotiate and sign a term sheet. And that's really where you put the sort of material terms, you outline the structure of the transaction. And it's typically non-binding, although oftentimes there will be a confidentiality provision and an exclusivity provision. Those can be binding, or oftentimes are binding. But as far as whether to do a deal or not, even if they sign a term sheet, they're not bound to do a deal. And so therefore, some founders, some companies think, well, it's not that important because we can always negotiate something different. Yes, you can, but that's not the right way to go about it. Because once you sign a term sheet, that's sort of your handshake deal. If you go back on that and then try to negotiate different terms with the investor, it just doesn't look good. And in some cases can really sour the relationship. Because as you sign that term sheet, it's sort of your reputation's on the line. If you're going to go back and try to renegotiate something you agreed to, it's just never a good scenario to be in. So make sure you understand it, you negotiate it, and you've gotten everything you need or want in that term sheet before it gets signed. And obviously, what we said earlier is make sure you've got all your company records in place, everything's current, updated. Be ready to clean anything up before you sit down and negotiate the term sheet. Because if there are things that haven't been done properly that need to be done, take care of them earlier on. Because once you sign a term sheet, the next step is essentially they're going to start their diligence. That they usually will do some diligence beforehand, but the real diligence starts once you sign the term sheet. So they're going to want access to your data room. They're going to be going through with their attorneys and other folks all your documents, your corporate documents and customer agreements and vendor agreements, other agreements and documents you may have. They're going to want to understand the technology. So it's really important to have all of that in place, organized, current, so that it makes the process a lot smoother. The less issues that they're raising during their diligence review, the less problems, the less delays, and it's just going to be that much more of a smooth transaction, and will be more cost effective too. Because if you need to halt, or they raise 3 or 4 or 5 things that need to be cleaned up, then you've got to shift your focus from what you're doing now in the diligence to going and cleaning up some issues, and then refocus back on it. It's never a good scenario, and it can cause delays. It also increases the cost because inevitably your attorneys are going to get involved in that, and they have to get involved to help you clean up things. And obviously, the more that they have to do, the more that translates into higher costs. So good to be prepared for that. Let's talk a little bit about the term sheet. I mentioned that's sort of the first document with your investor. It's really important to understand the terms, how they're negotiated, make sure that the parties are aligned before you sign that term sheet. But some of the things to be thinking about, and we'll touch on this over the next few minutes or so, is basically how much of the company are you selling? So what is the investment that the investor's going to be making? How much of the company are you willing to sell in this round? You should model that out, have a spreadsheet, figure out, okay, if I own 50% now, or I own 100% now, and I want to sell 20%, what does that mean? Is it one investor? Is it multiple investors? You're not going to know all the information to model it out exactly, but you can get a general sense of how much you want to sell, what the immediate impact is going to be with you. What are you going to end up at the end of the day with? just so you have an idea, and then keep that in mind as you start negotiating the term sheet. Dividends are something that you'll see oftentimes spelled out in a term sheet, maybe not necessarily spelled out, but there'll be an understanding that there'll be some dividends, generally speaking, on the stock that they're going to be acquiring. There's liquidation preferences, which essentially means if the company were to be liquidated, and that definition is critical because it's either, it can be a deemed liquidation event, which usually is defined to mean if the company sold, then we're going to basically call that a deemed liquidation event. And once the proceeds from that sale come in, there's going to be in the agreements, there'll be a waterfall or a provision that says, okay, the first money's coming in, go to pay these people, go to pay them the second level down, third level down. If this is your first financing, and assuming you have a small cap table and it's just the founders and some early employees and consultants, then generally speaking, the first money's coming in from a deemed liquidation event are going to go to repay the investors for the money they put in. And then the remainder will be distributed out, usually to the common shareholders or sometimes to the common and the preferred shareholders. And there's a lot of different ways to draft that. But the basic concept is the investors want to know that they're getting some preference. So if the company were to be in a scenario where there's a liquidation, that they've got preferential rights to get paid out first. Voting rights are important too. You know, what are the voting rights that this new class of preferred stock that you're creating is going to have? What protective provisions will they be getting? So VC investors or investors coming into a price equity round where they're going to be buying preferred stock, oftentimes are going to want some sort of protective provisions. And think of it as this is a way for them to protect their investment. So they're going to, you know, give you $10 million. You are, let's say, the founder, co-founders, you're the co-founders, you're the directors on the board, you're the officers. So essentially, you're running the company. The investors may or may not get a board seat. They may have observer rights. We'll talk about that. But essentially, the management, the day-to-day management, how to decide how the business is going to be run, what kind of sales are going to be happening, where are you going to get sales from, all of that is going to be managed by and undertaken by the officers on a day-to-day basis. So investors want to know that, you know, if there are really important decisions to get made, that the management needs to come to the investor and say, hey, we want to do this. We want to sell a division of the company. We want to change completely and go into a new line of business. We want to go take out a huge loan. Really major decisions that could impact their investment, they're going to have a right to have a say. And in some cases, you need to get their approval by a certain percentage, usually a majority, or it could be higher than that, to be able to engage in that action or that activity. So those are called protective provisions. Optional and mandatory conversion. So preferred stock it is a convertible security. By its nature, it can be converted into common stock. And there's usually mechanisms for that in the charter and the certificate of incorporation. But there are also provisions that allow either for optional conversion. So if at some point in time, preferred investors want to convert into common, they can do so. There's also provisions for mandatory conversion. So, you know, for example, if the company is going to be sold, then the investors will have, there'll be some sort of mandatory conversion so that the stock will convert into common stock. Again, that's all spelled out, but those are rights that are important to the investors because it gives them the ability to convert from preferred into common. And there's no reason for that. One example can be based upon the liquidation preference. So let's say they invested $1 million and the company is going to get sold for, I don't know, 100 million or 500 million. Well, from the investor's perspective, they may think, well, that's great, I'm going to get my $1 million back, but I'll stand to get a lot more if I convert to common. So let's say, for example, their $1 million early on, they got 10% of the company. And now the company is going to be sold for 100 million. You know, they could get their 1 million back as a liquidation preference, keeping their preferred stock, or they might say, you know what, no, in this sale, we're going to go ahead and convert to common, because when you take the $100 million and you distribute it out to the common shareholders, if I've got 10%, I'm going to get, and these are rough numbers, but I'm going to get 10 million. I'd much rather be a common shareholder and get a much larger percentage of that payout. So those are good reasons for why the optional or the conversion provisions are important. Anti-dilution is essentially protections that are built into the documentation so that if the company then goes at a later date and sells stock at a lower price than what the prior investors paid, that there's some mechanism to protect them. So either they get their stock changed into, the lower price stock, or they get more shares issued to them to make up the difference, or they get an opportunity to get more shares. There's a number of different ways it works, but essentially it helps protect the investor against dilution if you engage in certain activities, usually being you're selling either additional stock at a low price, or it could be an option to purchase more shares. If you go out and sell stock at the same or even a higher price, and they want to keep the same ownership percentage, they may have the right to purchase stock in that subsequent financing to keep their ownership at the same level. Investing for founders, we talked about documentation, attorney's fees. That's something that'll usually be in the term sheet. So from the company's perspective, and this is generally the market, is the company pays for its own attorney's fees. It also pays up to a certain cap generally on the lead investor's attorney's fees. And that's basically what's accepted and what's expected from investors in the VC financing. No shop confidentiality, we talked about that. No shop is another word for exclusivity. They don't want the company shopping around. So if they sign a term sheet, the investors are typically expecting you to honor that and not go shop around for a certain period of time. And then whether investors are going to get a board seat or observer rights, that's important too. And usually with these financings, there'll be, generally speaking, one lead investor. Not always the investor writing the biggest check, but oftentimes it is. And they're the ones that you really negotiate with. So they're the ones you'll negotiate the financing documents with, and you'll negotiate all those provisions. You'll negotiate the term sheet with them. Again, there's no absolute rules. Sometimes I've had deals where there's been 2 or 3 big investors, and they're all negotiating. But generally speaking, the lead investor does the majority of negotiations. So, they'll either want a board seat or observer right, and that's basically, if they're investing, they'll get the right to designate someone to sit on the board. Those are important issues to be thinking about as well. And I know we've got about 12 minutes left, so I'll go through sort of overview of what to expect in the documentation. We talked about the term sheet. The diligence process gets kicked off as soon as the term sheet's signed, as I mentioned. So they're going through, as we talked about, looking at everything. They're essentially looking for red flags. They're looking for issues that could potentially jeopardize their investment, or issues where maybe it's not going to align with their investment criteria. So it's an important process. It's the most time-consuming part of the whole financing process. It can, take days, weeks, in some cases months, depending on the type of deal, the complexity, the investors, how clean and organized the company is. But as that process starts, what will be done also in parallel is usually the attorneys for the investor will ask that the company draft the documents. Not always the case. Sometimes the investors like the documents to be drafted, but more often than not, the company is drafting the documents, or the company's counsel is drafting the documents. And I'd say probably 95% or more of the venture capital financings in the US are all based upon the NVCA forms, or the National Venture Capital Association forms. It's an established organization that is kind of like a trade organization, but it's for the venture capital industry. And they have created, and have had for many years, a set of model forms for a venture capital financing transaction. They update them on a regular basis. They actually updated them last year, and they recently issued some updated documents as well. So they are looking at them. And the nice thing about it is they are very well thought through. They're sort of the gold standard. As I said, most of the financing transactions use them. So they're pretty well vetted. You can download these forms now. You can go to the website and download all of their model forms. If you're looking to raise financing and you haven't been through the process, I would certainly encourage you to take some time to download some of the forms and read them, try to understand them as much as you can, because it's going to be important as you go through the process to be as familiar as you can with them. It'll make it a lot easier. Don't just rely on your attorneys who will understand them, know them, but you also need to know them too, because there'll be parts of the diligence that will be important, so that you can look at the representations and warranties and the purchase agreement and say, oh, okay, yeah, no, we can't say this, rep. We have to disclose some things, and then you would then disclose that on the disclosure schedule. So it's really important that you go through that, understand the terms as well. You can actually download, they have a model form of term sheet, for the financing. And that's a great starting point. So you can download the term sheet, which also has annotations and good notes, and go through that. And that'll give you a really good sense of what to expect. If you haven't been through the process before, that oftentimes is a good starting point for a term sheet you'll get from an investor. But essentially, that'll kind of walk you through all the different areas of the term sheet that you should be familiar with. There are some other forms out there. There was a SeriesSeed.com set of forms, another organization that started to create a different set of forms for venture capital financing that were kind of geared more towards a smaller transaction where maybe you don't need the full robustness of the NVCA forms. Again, the majority of deals are all done on the NVCA forms, and if you're doing your first price equity round, you may not have a choice because the investor may dictate what forms are going to be used, and more often than not, they're going to have them be set up on the NVCA forms. There's also some proprietary forms that some law firms have. Some of those forms are similar to the Series C or similar to the NVCA. But if you're familiar with the NVCA, then you're going to be in good shape and ahead of the game. Pre-closing issues. These are all things to be thinking about in order to get to the closing. So you want to be thinking about, are there any approvals that you'll need? Generally, you will need the board approval, you'll need the stockholders to approve the transaction, but you may also need other approvals. You may have given out side letters, i.e. an agreement with a early investor, or you may have a loan from a bank or some other party that has some rights in there that says, look, if you're going to go and raise financing, you need to come get our consent, or you need to notify us. Those are all important to know about because you don't want to find out last minute and then say, well, wait a minute, investor, we can't close because I need to go back and get consent, or I need to notify this other person, or I need to get a waiver of that. And it can just cause delays and all sorts of issues. Closing process we'll talk about in a minute. And then there can oftentimes be some post-closing items that need to be taken care of, such as filing security exemption filings to make sure you're complying with securities laws. There can be notices that need to be sent out to the stockholders who didn't sign a consent approving the transaction. So those things are important to make sure you keep on top of as well. So talking a little bit and drilling a little bit more into the type of documents you can expect in a venture capital financing. So assuming you're using the NVCA forms, you'll typically see the following suite of documents. So certificate of incorporation, which is, it's really an amended and restated certificate, because they'll take, in the financing, they'll take your existing certificate of incorporation that you filed when you created the company, which generally speaking is probably super short, because it doesn't provide much. It just has the required elements or provisions in there that the Delaware Secretary of State needs in order to create the company. You'll probably just have a class of common stock, and that's probably it. But when you go to sell preferred stock, you need to create that preferred class of stock. You need to build in all the protective provisions we talked about, the conversion rights, the liquidation preferences. So all of that means you're going to have to amend and restate and put in place the new charter, as we call it, or certificate of incorporation. And looking at the NVCA form, you can see the kind of things that go in there. But essentially, that'll be one of the important documents. The stock purchase agreement is sort of the definitive purchase agreement. That will govern the terms and conditions of the purchase of the stock by the investor and their investment in the company. So in there, you'll see reps and warranties. And these are reps and warranties that the company will give to the investors. There'll be a smaller section of representations that the investors are going to give to the company, that they understand it's a risky investment, that they're accredited, all of that fun stuff. The biggest focus, obviously, and it'll probably take quite a few pages of the document, are the reps and warranties that the company is giving, because the investors want you, if you're the company, to rep to them and tell them, hey, we don't have any problems here. We paid our taxes. We're not delinquent. We don't have any judgments against us. There's no active litigation. That if we have, IP, we properly registered it, and there are no issues. We're not aware of any infringement actions. It's all the sorts of things that the investors want to get a representation from or warranty from the company to help, again, mitigate the chance of there being a problem with their investment. And so they ask for a whole bunch of these reps. So from the company standpoint, as you're going through and doing the venture capital financing, you take the purchase agreement and then you start creating what's called the disclosure schedule, which is basically disclosing anything that you need to inform the investors of that ensures your representations and warranties are correct. So I'll give you an example. Let's say that you were delinquent on paying your California franchise tax over the last couple of years and you owe $10,000. Well, you'll see a rep in the SPA that says essentially, we have paid all our taxes, there's no tax issues, we're not delinquent, et cetera, et cetera. Well, you obviously can't make that rep because if you sign the agreement as is, you're misrepresenting that there's no issue. So what you do instead is you leave the rep, you can negotiate the reps and warranties, but really what you would do in that scenario is you would create a disclosure schedule, match up the term from the provision against the provision that says there's no tax issues, and then say, for these following years, we have not filed franchise taxes. The following amount is what we currently owe. Now you've disclosed it. Now the disclosure schedule with the representation in the SPA, you marry them together. Now that's an accurate statement because you've disclosed that you do have a delinquency and the investor knows about it. And you go down every single one of the reps and warranties in the agreement and make sure that if it's not accurate and correct as stated, you disclose on the disclosure schedule what you need to in order to make that rep accurate. That's a really critical piece because you don't want to miss something and then to come back afterwards and say, hey, you never told us about this. We've got a real issue. That's essentially a potential breach of your agreement. Investor rights agreement is by its nature, its title, there are specific rights that are given to the investors. These can be rights to access information, access company records, inspection rights, whether they're going to get a board seat or observer right. There's a whole bunch of other rights that are given to the investors. Again, essentially for them to protect and manage their investment and make sure that they're getting all the types of provisions that they need and want. And also thinking forward, so when the company does get sold or goes public, they've got the rights to be able to, again, better manage and protect their investment in those scenarios. A right of first refusal on co-sale agreement, that really is set up so that if the founders, who oftentimes are the key holders, not always, but these are the key folks in the company that have some shares, and oftentimes the founders, it could be, for example, you've got maybe not a founder, but the third person in the company was a CTO. They got some stock, and they're obviously a really key person to the company's success. They may be classified as a key holder. And so essentially, if those key holders want to sell their stock, the investors are given a right of first refusal to purchase their stock so that the key holder can't go, or the founder can't go and sell their stock to somebody else. The investors may not want to have that person be a part of the company, or they may want to protect their investment by being able to buy that founder's stock. So those sorts of provisions are in the right of first refusal and co-sale agreement. Voting agreement, by its term, essentially is an agreement that addresses some of the voting issues and other rights and preferences that the investors are going to want to have with regard to their investments. So designation of board of directors. How can the board of director, how does that agreement get updated? How many directors are there going to be? All of those sorts of issues are fleshed out in the voting agreement. And then you'll have some ancillary documents that are important as part of the process: board consent, stockholder consent. As I mentioned earlier, there may be other consents that are needed. There could be side letters. So in some cases, you might have an investor that is wanting to negotiate something different than what's in the MVCA, or maybe they're not going to be investing enough to be getting some of the rights that are called out in, let's say, the investor rights agreement. The investor rights agreement oftentimes will define a term like a particular investor as a major purchaser or a major investor. It's usually an investor that's writing a pretty significant check, and there'll be a threshold above which they are given major investor rights, which includes some additional rights that maybe somebody who's writing a smaller check is not going to get. But if you've got somebody that's not buying enough to become a major investor, but they're otherwise a super strategic and important investor, even if they have a much smaller piece of the company, then you may want to give them, or you may negotiate some rights that are less than what they would get as the major investor, but just, again, enough rights that they need or they want. And that sometimes can be documented via a side letter. So I know we're at 10 o'clock. I'm going to run through the rest of these really quickly, and then we'll open up for some Q&A. So talking a bit about diligence, I know we spent some time on it. Super critical part of the process. Start early, make sure you're organized. I think I talked about all of these. One thing I'll talk about, though, is the cap table tie out is a part of the diligence that's really important. And it's where you basically look at your cap table and you can go through every line item on the cap table. So every person that has any equity interest in the company, and you can point to and pull up and provide supporting documentations to evidence that they actually really are on the cap table, that they have the purchase agreement, they purchased the stock, or they were given an option. All of the terms that are reflected on the cap table are accurate and correct. The number of shares, the number of option shares, the exercise price, purchase price, all of that is accurate. And that's really important from the investor standpoint. It's important from the company standpoint too, because you need to know at any given moment what your cap table is. You need to know who's there, who owns what. But you also need to, from an investor's perspective, you need to know that it's all correct, because you're investing oftentimes with a particular goal in mind. You want 15% of the company for your investment. If the cap table is not accurate and somebody was left off that had a big piece, and they come and they come up after the transaction closes and say, hey, wait a minute, I bought stock 10 years ago, 5 years ago, 2 years ago, and I have 10% of the company. That's going to wreak havoc on the cap table, because now you've got a scenario where somebody's claiming 10%, the investor thought they were buying 15%. That 10% owner was never reflected on the cap table, and now they got a right to be on the cap table, and maybe have to be litigated or not, but it's going to screw up the whole cap table, and the investor's going to get pissed because now they thought they were getting 15%, but they don't have 15%. So anyway, that's why the cap table tie out is really, really super important. So anyway, those are some of the important issues to be thinking about. But let's transition now to talking about just getting investment ready, and I'll spend a couple of minutes, and then I think we can open up for Q&A. Clean company records. I think we talked about a lot of this, so let me just quickly see if there's something that we haven't discussed. We haven't really talked about data rooms. There's a whole bunch of data room providers. If you don't have one set up and you're getting ready for your financing, even if you're not quite ready for your financing, it's still good to have one. There's some good, relatively reasonably priced data rooms. What I would just say is I don't want to recommend any particular one, but find one that's reputable, that's known in the industry, that has really good cybersecurity, data privacy aspects to it. So they're either using a third party to verify they're doing everything properly, or they can give you the information that you can look at and say, okay, it looks like they're doing everything they should be doing, but they're very reputable and established, and choose one of them. And then once you've got that set up, start organizing your data room in a way that is easy for investors to get in and look at your documents. Be happy to provide you with some guidelines separately, but essentially it's looking at corporate records, material agreements, which can be broken down into customer agreements, vendor agreements, strategic type agreements, license agreements, things of that nature. You're going to want to look at, board consents, stockholder consents. There should probably be a separate folder for intellectual property, and there'll be some other folders as well that will touch on other areas of the business. But essentially, you're organizing it in a way where once you open it up to the investor, they can look at it, quickly go through it. They'll probably send you what's called the due diligence request list. They'll have a list of the ton of questions or documents they want. And if you created your data room and you've done it in a way that's kind of anticipating what they're looking for, it'll probably be, set up in a way that's fairly consistent with their request list. If not, you can probably shift it around a bit and quickly make some changes to make it marry the investor request list. The more you do that, the easier it'll make for the diligence process in a whole. Let's see, I think those are the main things. The other thing I'll mention is cap tables. We talked about tying them out, but what's important is there's a lot of cap table management programs out there, and you've probably heard a number of names. I'm not going to talk about specific companies, but there are a bunch out there. I would encourage you to go and read up on some of the different companies, maybe get a demo from some if you haven't done so already or aren't familiar with them. And you can basically use a cap table management program to manage your whole cap table. It makes it super easy, reducing the burden on the company. And some investors will require it, because then they can very easily go and look at their ownership holdings. They'll get access to information relating to their investment. It's just a very effective way to manage the cap table. Okay, let me. I think I'm going to pause there, and I have another program I do on how to avoid big startup mistakes, and some of these are fairly obvious. The one thing I will touch on really quickly is There are some companies out there that offer quite a bit of sort of early formation and even, tout themselves as helping you do a financing and, giving you all the forms you need. So don't go to a lawyer. We can do it all for you. I've seen a lot of problems with that. And I know sometimes with budget constraints, companies will form their company using, an online service that offers that. And some are generally okay, but I think the problem we see on our end is once we get clients that come to us now, they're ready for financing and they form their company using one of these services, oftentimes stuff gets missed because they're not law firms. They can't give you legal advice. So they usually have a whole bunch of disclaimers of what they're not doing. And if you don't pay attention to that, you sign up, you get all the documents, you think you're done. And meanwhile, you've missed all the security exemptions filings. You've missed maybe your 83B filing. You've missed some other things that now become an issue as you're getting ready for your financing round. So just keep that in mind. The ones that say they can help you do a financing and you don't need a lawyer, I would definitely stay away from. You definitely do want to have a lawyer because it's not just the lawyers that are drafting the documents and reviewing the documents. We're helping you negotiate the documents. We're helping you negotiate your term sheet. And if we've done enough of these deals and we're experienced in this area, we've got a good sort of historical knowledge about what's market, what's not, what's a reasonable term to ask, what's not a reasonable term to ask. And if you don't have that sort of insight and someone there next to you, helping you, guiding you, then you're not going to know whether a term is beneficial or not beneficial, or there may be some that you won't understand. And it's just not a great scenario for negotiating. You're going to be at a disadvantage. So those are the two things. Get your lawyer involved earlier on. I think you'll see it'll be a tremendous benefit. A couple helpful resources. We have a whole bunch of helpful information, especially for startups. You can visit any of these. Foley Ignite, we do a lot of articles and webinars and podcasts. We have a newsletter we publish. You can sign up and start getting, which includes a lot of information, not only about substantive areas that you should be aware of, but also trends and things we're seeing in the market. The Y Combinator site is good if you're thinking about doing a safe, very helpful, useful information. And then, of course, the National Venture Capital Association addresses there as well. I'll leave this slide up. It's got my email if you want to reach out separately. I'm going to turn now to our chats. Oops, sorry, let me go back. Okay. So let me now look at some of the chats and go through some questions. Okay. All right. So, let's see if there's more Q&A. If you do have questions, feel free to throw it in the chat. Let's see. I don't see on the Q&A piece of it. Okay, so yes, the slides that we shared, the recording we shared. Okay, here's a question. Now, the documentation mentioned CIIA or PIIA in the second slide. Do they relate to founders of the VC firm or for the firms the VC firm is investing in? Yeah, so if I understand the question, just going back to those early documents that I said are really important. So that the confidential information invention assignment agreements, that's the CIIA, or acronym synonym is PIIA. No, that's an agreement that the company will enter into with founders, employees, consultants, advisors, anyone who's coming to work for the company. That's not something the VC would ever sign or enter into. It's only for founders. It's only really for anyone who's going to be working for the company that's going to be developing something that could have value. There will be some confidentiality provisions in the financing documents. So when a VC invests, there will be in the suite of documents that we talked about, like the investor rights agreement, there'll be some confidentiality provisions in that agreement. So the investors that are putting money in the company, they will be subject to some confidentiality provisions in those agreements. So you don't need to have a separate type of confidentiality with the investors. What's the easiest, least expensive way to become a Delaware C Corp? About how much will it cost? A good question. I would say reach out to me separately. I'd be happy to give you sort of a sense of what our pricing is. Yeah, send me an email and I'll be happy to answer that and give you some details. Yes, copies will be provided of the slides. You should get that a little bit after the presentation. Okay, let's see. Yeah, so someone asked about 1202 issues, and 1202 of the Internal Revenue Code, basically referring to treatment of stock that is purchased, and what happens to it after, eventually, if there's a sale or an exit, can you get preferential treatment? So it's also called qualified small business stock, and it's an area that allows for basically you to avoid paying taxes on the sale of the stock up to a certain threshold. I think the threshold is 10 million. But you have to, the stock has to qualify as small business stock, qualified small business stock. And there's a number of qualifications. You have to be in the right type of business. The company can't be worth over a certain amount. It's a $50 million value. And there's a number of other requirements. So oftentimes investors, including VCs, are very interested in that, because if they invest in a company and they get that treatment, that the stock they are purchasing is eligible to get that treatment, that if there is a sale and their stock qualifies, they can essentially avoid tax on the first, whatever that threshold is, I think it's 10 million, on that first 10 million of proceeds that come in, they will essentially show no tax on. So it's a tremendous benefit for investors. And again, you'll see that investment rep in the stock purchase agreement, in the NVCA forms. Actually, probably almost any financing document where you've got a sophisticated investor, they're going to want to see that rep. And it's a rep that the company is stating the stock does qualify for that treatment under Section 1202. And that's one that's you want to take a careful look at. You definitely want to talk to your lawyer about. In some cases, it's fairly easy to look at that and understand the details about the company and say, yes, it qualifies. But there are a lot of nuances, and there are a lot of scenarios where, for example, if the company has redeemed stock within a certain time period prior to the investment, that could disrupt or taint the QSPS status of the stock. So there's a lot of scenarios where it could create issues for whether or not the stock is going to be qualified. So that's where we oftentimes will talk to one of our tax colleagues to make sure that we're can go through the rep and make sure the rep can be given, or if it can't be given, that there's a disclosure, or there's a discussion about what can be done to try to get the stock qualified and eligible for that. Okay, would any of the advice that we've given today change for startups that are remote first, have founders across multiple states? That's a good question. No, I don't think so. I think the only thing I would add, though, is a lot of the laws that apply to running a business are state specific. So if you've got a remote business, or maybe you've got a business that's set up in California, but you've got employees and advisors and folks in different other states that are doing things, you just want to be careful in the documents that they're signing. So the best example I can tell you are employment related agreements, or even consulting agreements. But let's talk about employment related agreements, because employee laws, there's certainly federal employment laws, but a lot of the employment laws are very state specific. So if you've got someone who's basically, working in Iowa for your company, and your company is based in California, that person is going to be subject to the employment laws in Iowa. And so if you have them sign an agreement, you want to make sure that your agreement is also compliant with whatever the employment requirements are in Iowa. And the reason why that's important is because if the scenario is reversed, let's say the company is based in Iowa and you've got someone working in California, and you want to have them sign a non-competition agreement as part of working with you, California has a very specific prohibition on non-competes. Essentially, they're not enforceable, with some very limited exceptions. But basically, if you're set up in another state and you've got a bunch of employees and you've got some in California, if you have them sign a non-compete, it's totally unenforceable. And there was a new law that went into effect this year that essentially requires employers that have any California employees, or that have California employees that have signed agreements that don't have California compliant provisions, then you've got to notify that person. That just went into effect this year. So really important to understand the specific state laws that may apply to someone that's working remote. Okay, another question here. I have a verbal agreement with a friend that he owns 50%, then he stopped investing and I continue myself. Do I have to disclose it to investors? There's nothing in writing, and I think I will give some sort of my own stock to him. I do not want to give him 50%. Well, talking very generally, again, I'm not giving you legal advice, but I've seen this scenario come up, and that's why it's so important to have the early documentation so that everything's buttoned up. But if you have a scenario where you don't have any documentation or any documentation, yeah, that's going to be a problem, because now you've potentially got someone who has some claim to ownership of some piece of the company. Again, whether or not the claim is ultimately going to be enforceable, and if they were to challenge and go to court, whether they would be successful is unknown. But it's a potential, and that would most likely be something you want to disclose to investors, because if you look at the rep in the SBA and it says, hey, here's an accurate picture as of this date of everyone that owns stock, everyone that's got an option, everyone's got an equity in the company. And if you've got somebody that may have a claim to equity, thinks they own it, they're not reflected on that statement, question mark, have you made a misrepresentation or not? So it's important to talk about that with your lawyer, because that's going to be an issue you're going to have to drill down into and come to an understanding of, okay, do they have enough there that they really do have a claim? Or if they don't have a claim and your lawyers advised you that they've gone through everything and assessed it, then maybe you don't have to disclose it. But that's really something you would have to go and talk to a lawyer about. But it's a great question. And those are the sort of things you should be thinking about. Another question is, I have outsourced some programming overseas. Do I still need to have an agreement with them that source code belongs to me? Yes. Anyone that's doing anything, creating anything for the company that has any value, basically you need to make sure that you've got the right documentation so that you own whatever it is that they're creating. It's, again, laws are different in different jurisdictions, but there is a common theme that you want to make sure that if there's IP that's being created or developed, that you own it, the company owns it. And if you don't have any agreement, again, it depends on the jurisdiction, but there are likely plenty of jurisdictions where if you don't have any agreement, the person that created it owns it. And absent some agreement that says they transferred it to the company, they will continue to own it, and the company will not have any ownership rights. So that can be a real issue. I gave you an example early on where that was a real significant issue, not having the right documentation. But I will say that it's also important to, from the U.S. perspective, a U.S. company, you've got someone working, let's say, in Turkey, doing some programming. You can have it, your U.S. attorney draft it, but you also want to make sure you're getting some advice from local attorney in Turkey, licensed to practice in Turkey, that understands the Turkish laws, because there may be something there that needs to be in the agreement in order for it to be effective and enforceable. And that your U.S. attorney obviously can't advise to that if they're not licensed to practice in Turkey. So make sure you cover the jurisdiction where the person is located as well. Okay, what would be the process for a non-U.S. company to access financing from U.S. VC firms? Would the non-U.S. firm need to register in the U.S. first? Great question. We see that come up from time to time as well. So, generally speaking, a lot of the U.S. VCs are comfortable investing in the U.S. They understand U.S. laws. They understand Delaware, as I mentioned, sort of preferred jurisdiction. They understand the corporate form of entity. And their preference, in some cases, their requirement is that they only want to invest in a U.S. entity. That's changing. I think I've been seeing more flexibility or more openness to investing in companies that are based outside the U.S. And then, of course, it depends on what jurisdiction. So, you look at jurisdictions that are very similar to the U.S. Obviously, England is the U.K. is one example, since much of our laws were based off of U.K. law. So there's a lot of similarity and commonality there. And so a lot of investors, if it's a UK startup, will feel comfortable, or maybe comfortable investing, or maybe they've invested overseas and they understand that and they're very comfortable with it. Same with the EU. Obviously, a lot of the countries in the EU established, have good laws in the books, have a good ecosystem of startups. So investors that have invested abroad and understand those markets and those jurisdictions, they oftentimes are very comfortable investing. So I think it's changed over time. But I think you still need to be ready, so that if you are going out to talk to investors and their preference is to have a U.S. Company to invest in, that you then can have a situation where you can structure it in a way that there will be a U.S. company. And there's a couple of different ways to do it. you can have the foreign jurisdiction, a foreign entity form a subsidiary that's a U.S. entity, or you can do what's referred to as a corporate flip, which essentially is you form, and let's say it's a UK company, forms a wholly owned subsidiary in the US, and then there'll be a share exchange, which ultimately ends up flipping that structure so that the US entity becomes the parent, the UK entity becomes a subsidiary. And now you've done this flip. Once the dust settles on that transaction, you've got a US company, and the VCs are now the US VCs that want to invest in the US company can invest in the US entity, even though operations are outside the US, let's say, and they're in UK. Okay. All right. So I think those are all the chats. Let me go back to the Q&A and see if there's anything else in Q&A. I think we've covered all the questions and don't see anything else. So unless there's any final questions that anyone has, I'm happy to give you 8 minutes back on your day. But great talking to you. Love this topic. Love talking to folks that are interested in starting a business or looking to invest in a business. Happy to reach out if you want to talk about anything. Feel free to give me an email, shoot me an email, and we can set up a time to talk. I'll go back briefly to the resources. Great information on these resources. There's a lot of other resources too. I mean, obviously, we spend a lot of time and effort to come up with the type of information that would be helpful, based upon where you are in your life cycle. But I think you'll see some good articles, webinars, podcasts, and things of that nature at these sites that we do, and then of course the Y Combinator and the NVCA sites as well. So look forward to hopefully talking to you on another presentation. But appreciate your time today, and if there's no other questions, have a wonderful day, afternoon, or evening. Thank you.